Becoming self-employed brings newfound freedom and flexibility, as well as a myriad of tax implications. If you're branching out on your own in Canada, it's crucial to understand the tax landscape to avoid penalties and unanticipated fees. This comprehensive guide will break down the essential tax implications for self-employed individuals in Canada, helping you manage your finances and responsibilities with ease. The first step to understanding your tax obligations as a self-employed individual is registering your business. Your business structure will determine your tax requirements and reporting obligations. In Canada, self-employed individuals typically operate as sole proprietors, partnerships, or corporations. Registering your business with the Canada Revenue Agency, CRA, will help ensure you are compliant with your specific tax requirements. Unlike traditional employees who receive a T4 slip from their employer, self-employed individuals must report their income and business expenses directly to the CRA on their personal income tax return. It's essential to keep detailed records of all income and expenses throughout the year, as you will need this information to complete your tax return. Depending on your income level, you may also need to make quarterly installment payments to the CRA to avoid interest and penalties. As a self-employed individual, you are responsible for both the employee and employer portions of CPP contributions. The amount you contribute is based on your net business income, with a maximum limit set annually by the CRA. It's important to budget for these contributions as they can add up, especially when you're responsible for both portions. If your annual self-employed income exceeds $30,000, you are required to register for and collect GST/HST on your sales. This typically applies to sales of goods and services within Canada unless deemed exempt or zero-rated. Be sure to keep records of all GST/HST collected and paid, as you will need to file a GST/HST return, usually on an annual basis, and remit any amounts owing to the CRA. While regular employment insurance, A, doesn't automatically cover self-employed individuals, you may opt into the A program to receive benefits such as maternity, parental, or compassionate care leave. To qualify, you must have earned a minimum amount of self-employed income during the previous calendar year. Keep in mind that once you opt into the A program, you must continue to make premium payments even when your self-employed income decreases or ceases. If you work primarily from home, you may be eligible to deduct home office expenses from your taxable income. These deductions may include expenses such as rent, mortgage interest, property taxes, utilities, and maintenance. To claim these deductions, your home office must either be your principal place of business or used exclusively for work purposes. You must also calculate the percentage of your home's total square footage that your office occupies to determine the allowable amount of your deductions. Many self-employed individuals use their vehicle for work purposes, which can potentially reduce your tax burden. To claim vehicle expenses, you must keep a detailed log of all business-related travel, including the date, destination, and purpose of each trip. You may then claim allowable expenses such as fuel, maintenance, insurance, and depreciation, based on the percentage of your total vehicle usage that is specifically for business purposes. The tax landscape for self-employed individuals in Canada might seem overwhelming at first, but with proper planning and record-keeping, it becomes much more manageable. By understanding your tax obligations and taking advantage of available deductions, you can minimize your tax burden and focus on growing your successful self-employed venture.